All right, excellent. Well, welcome, ladies and gentlemen, back on Closing Bell. You know, every Tuesday we bring our featured guest in, one of our channel partners and speakers, to come on our Tuesday event. And today we have a very special guest, a good friend of mine, Bryce Headley from Big Trends. And always look forward to having him. We haven't had him in a while on Closing Bell. It's been a bit of a while, but you know, we're very, very good friends. See him a lot at the expos and doing some speakings. And you know, and one thing that I always like to do is always bring someone special that focuses on something that everybody here likes to know. It's not just more stock trading, but you know, it's Forex trading, futures trading, options trading, and just a little bit to talk about Bryce Headley and tell you a little bit about him. You know, he's been trading as long as I've been around. Been over 20 years he's been doing it. He's one of the top options strategists, also trades Forex, also trades futures. He was also inducted into the Trading Hall of Fame back in 2007. Founder of Big Trends. You know what? He's been on everywhere. You've seen him time and time again, CNBC, Fox, Bloomberg, Forbes, IBD, USA Today, Wall Street Journal, Barron's. We're also going to be planning on having him on our next Cyber Expo. I know you guys had a really good last Cyber Expo we did last Thursday. We had over 1,200 people attended, and our top speaker back then was John Najarian from Option Monster. So we're planning on having Bryce Headley join us also. We always have 5 big speakers, so look forward to having him again. And I know I'm probably going to be seeing him probably next week in Las Vegas. I think he's coming down for the for the Las Vegas Traders Expo. So he's been around all over. So once again, it's an honor and a privilege to have him on Cyber Trading University and to teach and educate you guys a little bit more. So without further ado, he's going to close out the meeting. So Bryce, the stage is all yours.
Well, thank you, Fausto, and hello, everybody. It's really a pleasure to be always with Fausto and the Cyber Trading University group here today. Let me also confirm I'm coming in loud and clear. If you could just type in where you're joining us from today. I'm in Lexington, Kentucky, and as we say in trading, as long as you've got a good internet connection, you can do this from pretty much anywhere in the beauty of trading. So, okay, good. We've got folks coming in from all parts of the world, including Melbourne, Australia. Welcome from Australia as well as Canada and around the U.S. And many more. Glad to see you all with us. Let's get started without further ado. I really appreciate all the kind words from Fausto, and I do look forward to seeing him at the Las Vegas Trading Expo this coming week, starting off the middle of next week through the end of next week. If you haven't signed up for that Traders Expo, make sure you check it out. It's usually the biggest event of the year as far as the trading expos go. So bottom line is, what am I here to share with you today? We're going to talk about my top trading strategies from more than 20 years of trading experience. I started trading like Fausto back in 1990 at the beginning of the 90s wave. And, you know, it's interesting because we've been through so many cycles. We're going to talk about up and down as well as sideways cycles. And I want to make sure that I'm also keeping you engaged in knowing what's on your mind. And I know Fausto has a lot of quick traders on the equity as well as Forex and futures and options. I'm curious, what's your favorite trading vehicle, just so I can get a sense of what the general crowd bias is. We're going to talk about a little bit of everything today. We're going to focus on education. So we're going to really get zeroed in on how to educate yourself and get pointed in the right directions. We've got quite a few option traders in with us as well as some Forex and some equities. So glad to see that. And so I'll definitely shade it to make it relevant to options once we find the right stock. See, I'm a top-down guy. I believe you've got to understand the bigger picture environment that we're in and understand the trends that are going on, and then work your way down to the best stocks and then ultimately the best option strategies for those leading stocks on the way up and on the way down. We'll also talk about how we run scans, show you an example of a current scan in the markets, as well as ultimately how to execute these trades. So in a real simple graphic, it's education gets you pointed in the right direction. You know, you can't hit the target in the bullseye if you're pointed somewhere not even close to the general target. And so education gets you pointed in the right direction. That's what we're going to do today. Then you start narrowing your focus down to just a handful of candidates, and then once you find that particular point in time, that particular opportunity, it's about pulling the trigger and basically ultimately hitting the bullseye. So we're going to help you to find those opportunities and really, I think, open your eyes to a new way to trade, regardless of whether you're a quick trader over 1 or 2 days, whether you're swing trading over up to about a week, or whether you're more what I call position trading over up to about a month. There's something in here for everybody across all types of trader levels. Now remember also, of course, a necessary disclaimer, we will look at some current charts, but nothing I say here should be construed as a specific buy or sell recommendation. The bottom line is that I'll walk you through how you can follow these charts through, make sure that it fits for your own unique financial profile, and make sure you consult with your tax and financial advisor on anything that could affect your unique financial situation. You know that ultimately you are 100% responsible for your investing actions and results, and I'm going to show you a way that I think leads to better trading results based on a lot of years of experience, some of them from the School of Hard Knocks in the early days. I came in with both the blessing and the curse of a great education. I went to Duke University, and basically thought that I had figured it all out over the first year or two of my trading career, and had a lot of big run-ups, but I also gave back too much in the early days because I had a problem. And I'm going to share with you my initial problem in trading, and that was the problem of perfectionism. That if you think that you're such a great analyst and such a great trader that you're never wrong, you're in for a world of hurt in trading, okay? So I had to figure out in my plan of action, and I think it's important to share not just strengths but weaknesses. We want to talk about real world lessons over in my third decade of trading from the 90s to 2000s and now the 2010s. And the bottom line is that, okay, I was having trouble getting rid of my trades quickly enough that weren't working because I thought, well, I did the analysis. The analysis said that trade should be a winner over time, but let's face it, not every trade is a winner. You have to have a plan on how you're not only going to deal with your winning trades, but also how you're going to get rid of your losers quicker. If there's one thing I find in coaching a lot of proactive investors and traders, it's that most of you are basically getting rid of your winners too quickly and you're holding on to your losers too long. I was doing the same thing in the early days of my trading. I'm going to share with you today how I've really focused on taking partial profits, but also giving myself a chance to keep riding a big trend, but also how I find what I consider to be the best risk-reward entry points for my particular style of trading and how I can cut out quickly if it's not doing exactly what it's supposed to be doing. See, this is where you focus on a systematic game plan, and that's how I develop an edge focus here on technical analysis. Now, I'm a believer in fundamentals for the long haul, but let's face it, when you're trading the short term, you're basically trading the swings of the market up and down, and your job is to get in tune with those swings, to get in tune with the direction of the current, the direction that the river is flowing. If you fight that river, if you're swimming upstream, you're going to waste a lot of energy, a lot of time, and probably end up going nowhere or else get swept downstream against it. If you get in tune with that, you can actually enjoy the ride a lot more and ultimately be a lot more effective in growing your capital while intelligently managing your risk. So we're going to share with you how you still got to have a business plan, just like if you were, a lot of you I know probably own your own business in addition to having your own trading business. And let's face it, if it's you versus a competitor across the street, you better have a better mousetrap, a light bulb, an edge that allows you to keep those opportunities coming back around again and again and again. Every new person walking in the store is an opportunity for a business. It's the same thing with trades. There's a constant flow of opportunities out there, but your job is to make sure that you know which opportunities are the right ones for your capital and which ones you wouldn't want to tie up. If you're a retail store, you wouldn't want to tie up inventory and merchandise that wasn't moving. Then you'd have to go back to the drawing board. You want merchandise that moves, and that's what leads to the money in a retail business. In trading, it's the same way. We are not in the storage business as traders. We're in the moving business. We want to move those trades through and ultimately turn over our capital and grow it by that edge that we're extracting over time. You know about technical analysis probably being a a student at Cyber Trading University, the bottom line is that technical analysis has been around for centuries, going back to the Far East. But the bottom line is that really the technical analysis experience has mushroomed over these last 2.5 decades. When I started in 1990, we were staring at those green Quotron machines and the green letters, and remember, seeing that seemed high tech at the time, but looking back now, it's obviously that was kind of like the cell phone brick, the first one that came out. It was better than nothing. But now all of us, you have just as much power at your fingertips in a lot of cases as a lot of institutional investors do, and certainly as institutional investors had at their fingertips in recent years. Obviously, now you've probably become familiar with things like high-frequency trading and other innovations that are happening, and we need to make sure that we're not getting noised out by that intraday volatility. It's been incredible the amount of swings that we've seen in the markets intraday, and bottom line is that your job is to both get in tune with that and actually sometimes even take advantage of that overreaction that happens intraday if we're within a bigger trend. So I'll show you how I buy into those little dips that can happen intraday when we're in a good uptrend. And same thing in a downtrend, how we can tighten our stops and find good entry points to get back on the horse. And so as a technician, I care not just about all the news that's happening. For example, we just came out of the earnings cycle, right? The big third quarter earnings reporting period just hit in mid to late October. And bottom line is that in a lot of cases, the good news was already expected. And now you're seeing stocks sort of stall out a little bit here over the last couple of weeks since late October. And so now we're kind of in that digestion phase of all that expected good news. Now, we know that emotions are also a big driver of supply, that is sellers, and demand, which is buyers. And that comes in the form of, when people get too fearful, they've probably gotten sold out of positions and maybe the market's ready for an upside turn. Same way I would call greed actually a lack of fear. Once you lose any semblance of fear when it comes to your trading, that's dangerous too. You'd think that would be a recipe for just extremely confident trading, but let's face it, there's a big difference between confident trading and becoming arrogant or complacent or just plain old greedy in your trading, because what will happen there is you'll overcommit your capital, and the markets will make you pay for mistakes. You've probably had that experience. We all have if you traded for any length of time. But the bottom line is that the markets will tend to exploit your weaknesses. It'll basically see where you have an issue. And if you look at all the great traders over the years, the ones that have been in the business for decades, you'll notice that there's a common element. If you go back and read the books Market Wizards and the other Stock Market Wizards by Jack Schwager, the common element I found when I went back and reviewed what those great traders were sharing about their experience over literally decades was that they didn't risk too much on any one trade. And if you lose your healthy amount of fear that you need to make sure you're following your discipline, that you're never getting overly confident, you're not going to then overcommit your capital on the trade. I don't care how great of an idea you or I have, no trade merits an all-in or a super heavy exposure of capital. That leads you to eventually getting knocked, and so we want to make sure we manage that. So the big assumptions we're making when we look at technical analysis and how technicals work is that the technical analysis discounts what is already known about the market, known about the economy, known about the government shutdown and the debt ceiling. All those factors were basically worry factors that actually the stock market just kept climbing that wall of worry over the last couple of months. And so from that perspective, those negative or perceived quote-unquote negative news items that are lingering out there can actually turn into very bullish signposts, if you will, in the road. So you want to make sure that you're not just looking at the news, but if the stock market or a stock is failing to go down on quote-unquote bad news, that can be extremely bullish. Likewise, when you see that the good news is out and the stock's not going up anymore, that can be a problem. We can say, okay, at that point, that stock or market is fully priced. So these get priced in, and these are what we call a discounting mechanism. The market's usually looking about 6 to 9 months forward. So what you're seeing right now, people are already thinking ahead to what's it going to look like by, April or so of next year, May of next year, into the middle of next year. And so that's what you're seeing, for example, with the Fed. The Fed has obviously held off on their, potential tapering, as it's called, of their quantitative easing bond buying program, where they're pumping in $85 billion a month into the bond market. Hasn't shown lately in the bond market because the market had already expected that that was going to keep coming. So then once they thought that the Fed might pull off of that, the pedal and the gas that they were applying into the bond market, once that tapering was perceived, the bond market tanked, because now it's looking forward at what happens after the Fed has cut some of their bond buying power. So what happens, though, with the second principle here is that price action will occur in what we would call trends. Trends, to me, are where you start to see the action and reaction of a lot of different individuals to what's going on in the market. Let's face it. You know what happens when you're on the sidelines and you see a stock going up and up and up and up. You kick yourself, right? You say, why am I not participating in that stock? I'm going to show you, Joyce says she'd like to learn how to manage trades properly. Joyce, I'll show you and everyone how I manage trades looking at percent R. We're going to spend some time just on that one indicator today to say, okay, the percent range indicator Larry Williams developed, but I tweaked at Big Trends to really use it as a strong trend indicator. It's going to open your eyes to a great way to simply manage your trades that you can then build around. Now, the third key point here, after people start piling on this trend effect, is that, the past tends to be repeated in the future. You may have heard the phrase that if the past doesn't exactly repeat it in the future will at least rhyme with the past, that there will be some similarity, some commonality that you'll see, because, let's face it, we're all human. We feel these emotions of fear and greed. And so the psychology and the emotions lead to too much of a boom running into a stock and then too much of a bust coming back out of it. I mean, how many boom and bust cycles have you seen even since the late 90s tech run? I founded Big Trends actually back November 15th in 99. We're coming up on our Big Trends 14th anniversary since I started the company. And what's fascinating is that, in 99, everybody said, oh, that's great. You started Big Trends because of your success riding the tech wave and getting out in early 2000 before it cratered back down. But guess what? Look at how many bubbles have happened since. You've had, the real estate bubble up and down. You've seen what happened with oil prices surged up and then back down. Now come back up a bit. But now in the last couple months coming back down, you're seeing these cycles. And then, of course, you saw the gold surge up and now coming down hard this year. And, of course, you could even say bonds as a big bubble on the upside and now trying to be propped by the Fed, but perhaps poised to burst. So, from this perspective, you're going to see with this process is that you want to focus on meaningful trends. Now, we're showing you a couple past examples here first, but then I'm going to go in, I'm going to share my screen, looking at the current market, and actually, even take a look at a trade that we just made and just exited today in Lululemon on the downside, actually. So basically, just show you some examples of trades that we're making right now. But just give you a little perspective first. All I want to focus you on today, there's a lot going on in these charts you'll see from me, but we're going to focus on a couple of different things here. The percent R is an indicator that Larry Williams developed called the percent range indicator. All it is meant to initially measure is where the stock is closing on this bottom panel indication. And I use a positive scale, 0 to plus 100%. And all I'm measuring is if we're at 100% on percent R, that means we're closing at the absolute high of the range. Looking backwards over whatever range you want to define, I tend to use a little bit longer term range than most others would use. I'm usually looking back 30 bars of action. So on a daily chart, 30 days. If you're an hourly swing chart trader, 30 hours on trading hours would be about 4 trading days back. If you're more of a quick trader, I'd use a 15-minute chart, and we'll show you some examples of that where you could be in for a day or two max. So what you see happen here is that when we go into that quote-unquote overbought territory in the bottom left part of the chart, that is where most people would say, okay, when I say the word overbought, just a quick virtual show of hands, when I say the word overbought, do you think that you should buy it or you should sell it when I say it's going overbought? Okay, and by definition, everyone has been trained. It's rare that unless you've heard me talked before, it's rare that anybody says overbought means you should buy it. Okay, so all of you are telling me to sell it. To a man and a woman, everyone is saying sell because that's the natural inclination. That's where your training has been. But when I went back and I studied these examples and I said, hold on, when something, and one of you says hold, okay, so Lee broke the cycle of sells. We had about 20 sells, no buys, and 1 hold. Sounds not like a Wall Street brokerage firm. They'd be on the other side of saying buy, 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 and never saying sell, right? But bottom line is that what we're looking at here is that when it goes overbought, but and if indeed it can't keep going up after that initial overbought point on the bottom left part of this chart for Vegas Sands, if it stopped there, then yes, I would agree that that was just the top of the trading range. But what happens when a stock that goes overbought then keeps going up? What's happening? How can that happen? If all of you are telling me that an overbought stock should not keep going up, you should sell it, why isn't everybody selling it there? Who's buying it? Well, it stays overbought because the institutions are hopping on board. Let me let you in on a little secret. Institutions are just as vulnerable to crowd psychology and this trend effect that I'm talking about as you and I are as individual investors and traders. The bottom line is that institutions feel pressure to keep up with or to hopefully beat an index of, the S&P 500 or whatever their other relevant index is. And all they care about is making sure that they're a part of that up move when it's working and that they can kind of manage their way through the down move, so maybe miss a little bit of that down and thus lead to a little bit of outperformance. That's how an institutional investor thinks. If you're an institutional investor and you're sitting on a bunch of cash as the market's going straight up here, what's going to happen? You're going to show that you've had no growth and the market's gone up 20% a year the last couple of years. What do you think is going to happen to your job if you're an institutional money manager and you're flat? You haven't lost any money, but the market's gone up 20% a year. You're going to lose it pretty quickly. That's right. And if you're looking at it from the institutions driving the market, we all know they do. You're also, if you underperform, you may miss out on your bonus, which is substantial. I talked to a buddy of mine that I've known since childhood who went to work for a big San Francisco money manager back in the beginning of the 2000s, and he was celebrating at the end of 2001 with me that he was following the telecom sector, and that had a cratering down there in the early 2000s, and his sector benchmark was down 30%, and he was saying he got a big bonus because he was only down 20%. And he said, oh, he crushed his index. He beat his index by a full 10 percentage points or 1,000 basis points for you techies out there. And so he was celebrating, saying he made hundreds of thousands of dollars in bonuses for only being down 20%. And you can imagine what I'm thinking. I'm sitting here scratching my head going, maybe I'm in the wrong game here because that's kind of crazy, right? I take an absolute mentality. I know you all do too. The bottom line is minus 20% isn't what we want. They're going to have to overcome a loss. We need to manage that risk. Okay, so the bottom line is we don't think as individual traders like institutions. We want absolute gains on the way up, and even in bear markets, we can make them with options, with put options on the way down. Now, again, what we want to make sure we're a part of these moves while they're breaking out. Now, what you'll see here is that you'll see times where it looks like it's coming back underneath that overbought threshold. And for Vegas Sands on this left side of the chart, we'll look at the right side of the chart too. There's 1, 2, 3, 4, I call these retests. And then 5 retests, it still holds there. Each one of these, it comes back under that oversold territory. There's the 6th retest, and then the 7th one's going to finally break. Okay, so what these retests represent, Joyce was asking about how to manage the trade, is that every one of these lows here becomes a support point. It's almost like a stair step upwards. Okay, it's like if you think of a stair step or an escalator, that you notice what's happening here. You're literally forming an upward stair step until this last stair we start to then descend back down. So when this happens here, in this case, that's the final exit right in there when it violates that on a closing basis. It's not intraday or intrabar that I look at. I look at the close of each candle or bar, not overreacting to what's going on during the bar, because otherwise you're going to get yourself whipsawed like crazy. But bottom line here is that on this particular chart, that gave you 6 different re-entry points where if you missed that first buy signal breakout back in early March, you weren't panicking because you're saying, I'll wait for the next retest. Now, you can see we've got CCI in here. We have my acceleration bands on the upper panel, which actually helps me miss kind of this next move here because it doesn't really break outside of this band. So I look at not just %R, but I look at other tools here, and you can see what happens, for example, as Vegas stands on the right side of the chart starting to break on this last signal here. It goes overbought right back here, and then it closes above that high right there, the very next bar. That's what's giving us our buy signal. That bar is closed right there in early September. And so you can see now it just starts launching to the upside. Notice it hasn't really broken those upper acceleration bands yet, but I'd look for that move. We're starting to now break out of those acceleration bands and then being patient and stalking the trade to what I call a retest. There's your retest. Yes, it's back into the bands, but that doesn't worry me. As long as that low is not violated, that's a great spot to get what I call a re-entry point, okay? So clearly you can see here that when you get that kind of a re-entry coming off that low, and if I'm wrong, by the way, I'm going to stop it out real quickly if it closes underneath that low at about $38. That one launches up to $55. You can see, of course, that's the peak. Now, we would not be getting out of the peak. We would be waiting. You know, of course, we can take partial profits along the way, but we'd be saying, look, there's our next retest coming in here, and then a couple days later, it has a slight violation here at about 48.5. Okay, so that was good for about a 10-point move in Vegas Sands in about a month or just under a month's time. Now, what I use CCI for is just a confirmation of that move there, Pat. So CCI just serves to kind of validate what I'm seeing in that chart. So, and what you also notice is that when %R is not giving us any kind of action in here, when it's just kind of stuck in the mud, we stay away from signals in that circle, big circle period. So that'll keep us out of choppy markets and say, look, let's wait until you get a more clearly defined trend. If you're an options trader like I am, you cannot afford to sit and wait. You know, time is not on your side as an option trader unless you sell premium. But what I find is that premium selling can work, but the bottom line is that I've made more money over time buying options and then managing my trade carefully because you have a theoretically unlimited leverage potential buying an option. You can only make so much when you sell an option. And so the bottom line is that both strategies have some application, but for me in this case, keeping it simple is going to really help us. We're going to come and look at some current market charts here in just a few minutes too, but I just want to basically remind you that we're not focused on fundamentals here. You know, you don't want to buy a quote unquote cheap stock and buy calls on it and sit and wait and wait and wait. We want to make sure that we're really focused on, you know, stocks that are moving. And the technicals keep it simple because we're just focused on price and money flow in the form of volume. So how much is coming into a stock, how much is coming out of a stock in terms of the actual buying and selling interest. That'll show us where these trends are starting to develop. I call this market structure. You know, if the market structure is right on a stock or on a Forex market or on a future, you name it, and then the corresponding option trade, then that's where we get great opportunities to trade. If the market structure is not right, if you try to force a trade, you tend to get yourself in trouble. We're looking for those repeating patterns and using that past pattern action to help develop new opportunities going forward. Now, what you probably noticed when I was showing you how that first %R buy signal was triggered is to increase my consistency, I found that the first overbought move can whipsaw you out if you were potentially just trying to buy it right as it went overbought, because it might well be the top of the trading range. Sometimes it is, and sometimes you'll see the market stop and even reverse off of that. So what we needed to do is say, okay, we don't want to buy into the top of a trading range, but we do want to buy once we know it's a confirmed uptrend. So the first overbought bar there is what we call setup. It's the starting kind of, like if you're a drag racer, you'd say, okay, you know, it goes from red to yellow, and you see the engine's throttle, and they're getting ready to take off, and then it goes green with the confirmation, and that's where you hit the pedal to the metal and you floor it. You know, basically the race is on at that point. And, you know, from this perspective, you know, we find that a lot of setups fail. And so setups are, I mean, you probably experienced this yourself. How many of you have had the experience where you feel like you were waiting for a turning point on an indicator, you're waiting for it's a MACD crossover, a moving average crossover, coming out of an RSI mode, overbought or oversold. You're waiting for that turn, and then it looks like it's turning, and you want to be there right as it turns. So then you jump in, and it's almost like the market was waiting for you to jump in, and then it immediately shoots back against you the other way, almost like to the moment that you put the trade on, and then it starts working against you. Anybody ever had that experience? Unfortunately, we've all had that experience. Some of that's just trading. And the reality is trading can seem like a lonely game because it's you looking at your monitor and saying, okay, am I reading what's going on properly here, okay? Some of you just had it today, and no, never, with a big smiley face, right? Everybody's had that feeling. And what I want to do is minimize that feeling, because that feeling, and by the way, you know, we're talking about emotions here, and this is Trading Psychology 101. Those feelings are getting imprinted onto your internal landscape of your ability to believe in what you're doing and to stick with it. If you're getting chipped away at it, if you're like a rock, but it's getting chipped away at underneath because of all these little whipsaws, these little fake outs, these little frustrations from trading, those little, the market did it to me again, whipped me out. You know, those little chips at the bedrock of your foundation of your confidence eventually will erode it to the point where then you won't believe in your system if you keep getting whipsaw like that. So you've got to avoid those whipsaws. And for me, the first step is being willing to wait just a little bit. Now, this seems very counterintuitive. We're all out there seeking to get an edge, trade, be in there ahead of everybody else, but sometimes that can be very detrimental because a lot of people are getting whipped trying to call those turning points. What I've found is that the best trends, the trends that really have what I call persistence, that is that once they get going, that they can keep going, kind of like a rocket into orbit. Once it gets into orbit, then the boosters peel off and it coasts on its own momentum for quite a while, right? You don't see those rockets, once they really get up into orbit and the boosters peel off, you don't see them come crashing back down. They're worried about them when they're first launching, right? If they don't get enough thrust, they can come right back down to earth and crater. And so the bottom line is we want to avoid those situations. But the bottom line is that sometimes they're going to happen. We can minimize that by waiting for this confirmation. The confirmation is sort of like me saying to the market or to the stock, prove it to me. Show me that, now we've seen this setup, show me that you want to follow through it. You want to keep going in this direction that I believe it looks like you're setting up and getting ready to go there. And that's why not just the breakout method, but also the retest method has been so effective for me of saying, hey, even if it blasts off and I miss that first blast off, which happens, you know, I'm not perfect, and frankly, that was, just to say those words, was a big accomplishment for me in my first couple of years of my trading, because I thought I thought I had it all figured out, and I was very stubborn, and I was taking losses I didn't need to take in my own account. Like I wasn't doing that for others at the time. I was just saying, look, let me just figure this out. And so some of that's the school of hard knocks. Now that we actually have trade alert services, a big trend where we say, okay, this is our new buy, here's our stop. We go right in with, once we're in, here's our stop every time, so that you know what your risk is coming into that trade, and you never pull that stop. You always say if it gets hit, you get knocked out of the trade, we move on. Okay, so define your risk as a rule every time right on the front end when you get into that trade. So bottom line is that, you know, what we're saying here is that, okay, we want to find those patterns, and then we want to go take advantage of them. We showed you one on the upside. Here's one from the downside. You know about the maker of the BlackBerry, Research in Motion, now actually has a different symbol, BBRY, but in the day, REM was a symbol. And this is a classic case where we didn't know it per se directly at the time when REM was getting pounded on the downside a couple years back, but ultimately, you know what the reason was now, right? It's because of a couple of companies called Apple and Samsung and Google, you know, that basically were eroding the BlackBerry's initial leading position. So they were one of those first movers in the smart or the cell phone market, in the pager market. But the bottom line is that their innovation didn't keep up as we migrated to the all-in-one smartphone device. Now, we can say that in hindsight, but the reality is the technical chart showed you while it was happening that we were getting this breakdown. Now, to flip these rules around and say, well, for a bearish signal, now we're talking about a stock like Research in Motion that went oversold. Remember on this bottom panel here, we're looking at the oversold percent R indicator So, okay, when it goes in the bottom 20% of its potential readings here, then if it closes underneath that oversold bar's low, then it's not the bottom of the trading range, but in fact is getting dumped by institutions and investors in a bigger way. And so that's our first sell. And by the way, the first sell here, you see it was below the acceleration bands. Everything looked like it was ready to plunge there. And it started to work down from the mid-50s down to about 50, but then it came back up and it stopped us out. This is a good time to talk about stops. Here's a retest on the way back up, and you say, okay, well, this thing should hold right into that high right there, and you can see what happened. It violated it at the next day's close. Unfortunately, you can see that was a bad stop out because then it did shoot back down. This is, though, one of the good things about the %R indicator is it's quick enough to adjust, especially the big trends way that we do it. Say, okay, look, when it breaks down again on the gap down here, we're saying, look, don't chase the gap necessarily. We're saying what happens after that setup. In the very next bar, it had the slightest close underneath that to re-signal there at the start of May on the downside. And you can see it doesn't quite come in for a retest on, it gets right into it right there actually. It retests up into that 20% line. And if we'd closed above that high, you would have seen us stop out of that. But instead, you can see there's another one, even at the beginning of August. Even if you missed the rest of that move, that retest from 25 down to 21 over the next 3 days, that's almost, about a 16% move down in the stock in just a few days' time, if you really are paying attention to these good entry points within this. Now, you see, we would scale out of at least part of our profit, and then you see it's going to come back and actually violate that stop and actually knock you out of that thing soon after that. So bottom line is that now you're done with that trade, and saying, okay, now it's, you don't buy it at that point. You just say, okay, now it's back into what I call the no man's land, in the 20 to 80th percentile range here. We say, okay, we're just going to stay away from that type of a play. So, you know, what I want to show you actually, so I've showed you a bull and a bear here, but I want to also get into kind of backing up. You know, we're going to talk just about, for now, the %R rules along with the acceleration bands. So acceleration bands, an indicator I developed, sort of piggybacking off John Bollinger's Bollinger Bands, which I liked, but I felt were too quick to kind of overreact if we got a big stock trend developing. They would chase after the move too quickly. So the acceleration bands I developed in the late 90s to really help me to ride these big tech moves and these other big breakouts that were happening, and I wanted to be a part of those. And then we'll talk about just some more of the %R fundamentals here. So let me actually, just for a second, these are all tools that I use and that you learn about as you go in your big trends experience. But what I want to do first for a second is I just want to share, let me share my TradeStation window here off my desktop here for just 1 second. And we're going to basically go in here and say, okay, let me just show you what we're looking at here. So I'm sharing my desktop real quick, because I don't just want to show you old examples. I want to also show you things that are happening as we speak. Okay, so this is a combination of charts. Let's actually start with the daily chart on the S&P, and you can see. So like Fausto mentioned, like some of you that are futures traders. Okay, you don't just have to use the S&P. You could use the E-mini futures, right? So you could say, okay, E-minis, ESZ 13. Okay, December E-mini. Bottom line is that same pattern happening here. When we go overbought, like this latest move here, went overbought on the E-mini up here, October the 16th, we would say that that high, let's zoom it in for a second, that high, this is in TradeStation, but you can do this on multiple platforms with the %R indicator, just using it the big trends way. That high was 1717 even. So we closed the very next day above 1717 at 1727. You say, hold on, you're leaving 10 points on the table. And I'm saying, yes, I'm doing that to basically say if I can get then the confirmation, buying the next bars open in this case. We'll show you the intraday charts in a moment too. And you can see not every signal is going to be right. That sometimes if you see it get a confirmation, then this one happened on a big gap up. And then when it came in for the retest, we believe that's really setting up a nice lower risk entry point. In this case, it violates the very next bar. You're going to be out right behind that to say, okay, take your quick loss off that 1701 retest, violated, closes 1692.75, just under 1693, and so you're getting out the next bars open. Well, look, if you miss this first breakout here, you see it was a nice move in the futures. on the daily chart from 1727, peaked at 1773, up almost 50 handles there. And then, but look at what happens. If you're patient, you wait for your retest. In this case, the daily chart shows a retest 1742.50 last Thursday, 1742 and a quarter actually. And look, it trades below that there on Friday morning. Don't overreact to intrabar action, because those are what we call the bend but not break signals, where it flips back up and shoots way up. Got to be a great low risk entry point in my view, because hey, if I'm wrong, I'm going to get stopped out if it closes under that Thursday low. Now, if you take the same mentality, we'll spend one more second on the futures and we'll go back over to stocks. You look at it, say you want to look at, here's the hourly chart. And you can see the hourly was a little whippy on the last couple of signals. You know, it gave this what looks like hit just at 80, then it followed through. So saying, okay, it should get going. It flips right back down for a retest on that same bar at 1767.75, and then boom, a point lower than that, it stops you out 1766.75, or the next bar is open 1766.50. So, you know, and you can see even today how it's trying to then go short and flipped right back up. I have no problem on these retest points when it flips up, putting a trade on into the teeth of that, because I've found that those are some great low risk opportunities. Now you can, if you take a little bit bigger picture step back though, you'll see some of these monster moves from early October where we got a signal at 1657 that in 2 days was at 1700, 43 points. You know, so you see those moves happening there, and bottom line is there's opportunity there. Now, for you quick traders, I know a lot of you like to be in and out of the futures. You'll see on the 15-minute chart some real nice opportunities, including stuff that's happening not just during the trading day, like back here on the jobs day today on the 8th, this past Friday, we got the buy signal 1754. And look at how it just stays overbought. How does %R stay overbought through that whole period right there? Because %R means percent range. And percent range implies that the range would be stable. But remember, if you keep making higher and higher and higher highs, and we keep closing near the high end of that range, what's %R going to do? It's during that trend, it's going to stay up near its 100 percentile reading, because you keep closing up near the high of the range. You're losing older data back here as you go forward. And so as we start coming off of those highs, we come in for what we call a retest. And that retest eventually gets violated. Actually, the next retest gets violated there. It tells you to hop out of that trade. You can see a little choppy today. We saw, you know, a sell coming in the early morning hours, about 4 a.m. this morning at 1765 3/4, and it popped down about 3 points, and then it backed off, and you see only made about a point by the time that signal was stopped out. So that's going to happen, but the bottom line is this is how you would do this kind of an approach. Now, I did also say, what about futures? What about Forex? So, you know, if you were looking at, say, something else like, say, the U.S. dollar versus the Japanese yen, you know, this has been a pretty phenomenal chart as well. It'll take a second to load. You see right now, not much going on. It is on a new buy signal for the dollar versus the yen, which on this very short view doesn't look like much. But when you factor in just how strongly trending the dollar's been against the yen from earlier in the year, look at that. Going back to late last year, look at the breakout. It broke out U.S. dollar to yen down in the 80s, 81.16. And you see, came in for a retest. There's the retest, back under that 80th percentile reading. And that low had to hold on a closing basis, 81.715. It did, and then it blasted off. There's another retest. So every one of these tests, you could actually not just tighten your stop, like Joyce was asking how to manage the trade, but you could also say, I will put a trade on into those retests, because I know on a risk-reward basis, I've got relatively low risk to buy that dip within the uptrend. It's like buying the lower end of an uptrending channel. Now, eventually, I'm going to be wrong. You see about the 4th retest works, then the 5th retest in here is going to stop me out. And this one stops out here at 91.799, 91.8 essentially, compared to the entry there, which was at 81.16. So you're talking about basically about a 12.5% move in the dollar versus yen. That's a huge move, and obviously the leverage of those Forex moves is tremendous. So this is a new buy signal for the dollar versus yen. It would be more powerful if we could close over this upward acceleration band, which is right at 100 on the nose. So we'll be watching 100 as well as a place where you could start a position here. You could start to build a smaller position, but you'd want to add to it as you saw continued proof, and really love to add as we get to retest points when it tests back under that 80 percentile. Because if we're wrong, we're going to buy that dip, and then we're going to get stopped out and keep our risk very small. Okay, so a lot going on here on these charts, and bottom line is I'll come back and look at some more of that here. But one of the things that I do, and actually it's not showing up on this particular panel. Let me actually pull it up on another panel. We've got all kinds of other indicators we look at to back up what we're seeing. Is I look at what we call radar screen within TradeStation. Now, I don't want to boggle your mind with numbers here, but for example, on a daily interval, I can go into something like %R, and I can say, hey, show me what's giving me a big breakout or a big breakdown. And so, we actually, just for, disclosure, we own CME calls. CME had a bullish confirmation on the daily chart. This is the Chicago Mercantile Exchange. It's backed up by a strong CCI as well. That's all that green shows me. So these are candidates. It doesn't mean I'm telling you to buy anything here. Another one is Open Table that's starting to show a breakout here. Yesterday, the S&P was showing a new move back over that 80th percentile, but that was just off of the retest that it had last Thursday. So it's been still an active signal. If you've been paying attention to Transocean Offshore, RIG, the company that's involved with BP in that whole Gulf oil spill debacle. Well, if I go in and I just say, well, what about RIG? Well, if you were paying attention to RIG, Carl Icahn came in and said he was basically working with the board to get, some turnaround going for this one. He viewed it as an undervalued stock. If you go and look at the intraday charts, look at what %R is doing for you. You can see, especially on this latest move here, the first move, when it went overbought, it didn't follow through. So if we get a first overbought move and it tries but fails to close above that high, and then it comes back underneath, what do? I turn it off. I just say, well, I'm going to pass on this. Now, I'm giving you a lot of the details that, frankly, I would usually give to just my paid clients, but I want you to see what you're missing. I want you to see just how powerful this is. You can go, when you go to your chart platform after we're done here in just a little bit, plug in a 30-bar percentile. Now, there's a lot more that just goes into it than just %R, but this will get you starting to see the charts in a whole new way. We say, hold on, so Headley said, okay, it goes overbought. Should I buy there? No, because it doesn't close over that high, 48.59. This is the hourly chart for RIG. It finishes back underneath there. So, and then when it finishes back under there without confirming, we say pass. The next one you can see, it starts to go here, tries and fails there, but then it crosses back above right here, 48.87, and that was happening late in the day last Wednesday at, 49.01, right there. So it was buying the next bars open, which actually happened on the gap. It actually, if you were paying attention, you would have gotten the signal right to close at 49.01, but in this case, it's buying on the gap up because it's just saying, hey, let's be real world. If you missed it at the end of the bar, you'd be buying the next bars open. And look at what's happened with %R. It's just stayed overbought. Now, am I telling you to buy RIG here? No. I'm saying RIG would have to drop back down under the 80 percentile in order to show you how that really would be a better low-risk entry point. Okay, I've gone through a lot of charts there. What I want to do is I want to come back to the PowerPoint presentation here for a second and just key on a few more principles of trading. Okay, so that we showed you this on different time frames because, and then I'll finish with the trade we just made and cashed in on Lululemon, the women's athletic gear maker, yoga and such, here in just a minute, in a few minutes. But let me finish on a few other key concepts here. So, one of the key concepts is you'll see times where, like, Netflix looked like it was breaking down. This was from a prior year. Now it's broken back out to the upside this year. Actually, one of the % moves this year caught it from 100 to almost 200 for a near doubler just in the stock. We're not even talking about the leverage of options yet. And by the way, when I know a lot of your trading options, first rule of thumb for options traders is buy the in-the-money options. These are options that have a lot of intrinsic value, and get at least 2/3 of your total option premium as intrinsic value and no more than 1/3 as time value. So what this means is, say you've got Apple trading at 520. If you buy a 515 call if you're bullish, That's 5 points intrinsic value because you have a right to buy it at 515, stock's up at 520. You could theoretically exercise that and pocket a 5-point difference. What I'm telling you is, if I can't buy that option under $7.50, and preferably even less as you get closer to the expiration, like for those of you who like to trade weekly options, we do a lot of weekly options trading in the final week of an option's life. If we can buy that in-the-money option where it starts losing a lot of that time value and it trades a lot like the stock, that's what we call a high delta option. An option that's going to move very closely with the stock price. That's where you get super leverage, leverage that goes well past 20 to 1 and can go up into the 40 to 50 to 1 area for a stock option. That's previously unheard of for even very short holding periods of a day or two. So Netflix, you can see the first two signals here were not working, and the retests were getting violated. This first one had a retest that ever so slightly violated and knocked you out right here. And then you see the next one came in for another retest, and then look, that high is getting violated too. So you're getting knocked out of a couple of these bear trades. And what that's tempting you to do is it's tempting you to say, oh, this doesn't work. I'm not going to take any future Netflix signals. Well, you can see what happens. The market then surprises the majority of people who've been maybe burned by that past couple of little whipsaws. And you see how it starts to break down, and then the stock goes from an initial sell at 220. The two closes under the lower acceleration band was about 150 on its way down to 80 bucks. Okay, this was as Netflix was collapsing, and you see what happens to the %R. It just stays in a massively oversold range in the bottom 20% of its moves. Once this thing retests, you could actually get another signal to say that resistance should hold. That one did, and it snapped down about 10 points from 90 back to 80 over the next couple of weeks. So, pay attention to these opportunities, and you'll see how to take advantage of that. Now, as I mentioned, delta is where we really want you to focus. Delta is how you're going to get, a high delta, high intrinsic value option. It's going to lead to, say I've got an 80% delta. It means that if the stock goes $1 in my favor, I'm going to make 80 cents on that dollar in the option. You say, well, that still sounds like I should buy the stock. Well, the stock's at $100 and it goes to 101. If you bought the 95 calls and they're 5 points in the money and you paid, say, 6 for them, well, if I tell you it's got an 80 delta, that means your $6 option just went up to $6.80. That means that you're up about, You're up about 13% on that option for a 1% move in the stock. That's great leverage. We want to manage the theta, the time decay in the trade. I don't recommend on short-term, especially in weekly options, that you do anything with at-the-money or out-of-the-money options. That is highly speculative and high-risk trading. I want to take that risk level down significantly by buying a more in-the-money option that trades more like the stock. And then gamma is how much the option will actually pick up deltas. So that usually gamma is highest right near the strike price. But as we're talking about shorter-term trading, for a lot of you short-term stock traders out there converting that to options, I would suggest you focus on a higher delta option. Let me show you an example of that. One more sharing of the chart, and then we'll show you how you can keep your learning process continuing here to answer any final questions. Let me go back to sharing my screen here, and we're going to talk about Lululemon. Lulu, L-U-L-U, is a symbol, and this is a trade that I put on here in the last week. And bottom line is that what you'll see here is that, here we go. Okay, it's coming back up. Again, this is in TradeStation. Let's just maximize the chart a little bit here. Starting with the daily chart, look at what %R was showing us here. Lulu, they had this bad news a couple quarters ago where they announced they were recalling a popular clothing item, pants, I believe it was. It was too sheer or see-through. Not good for the ladies or for anybody for that matter. And bottom line is that, that what we saw there is that was a big breakdown, and then the downside follow-through showed you an initial bearish signal that was, good for about another 10% drop in the stock. You can see that since then we got another breakdown here. This one was starting to shoot down into the bottom 20% of its readings, and then it followed through. Then we came back in for a retest. Now you can see that it was getting that retest, and it slightly violated that, so it's telling us to hop out and then hop right back in. So we've been in that one for the last few days, and you can see, look at now the other time frames. The hourly chart showing that we had one prior breakdown move back here about a week ago, week and a half ago, and you see we're going oversold and we're continuing on down. There's where you would tighten your stop right off the bat high, or you could even re-enter there and say if it violates that 69.59 high in a future close, I'm done. It tries to go above it during the hour there, and it flips back down by the close. That's why we wait for the close in any time frame. And then in this case, Lululemon's close were recalled, but bottom line is that we're talking about the close of the candle there, and you can see there's your next retest. And this one was violated on a little bit sharper up move than we would prefer, but that happens from time to time. It's worth it to us to still stick with it. Now, you can see right now it violated this morning and it followed through, and you really see it on the 15-minute chart. We basically, saw the breakdown on the 15-minute chart this morning. The bottom 20% of readings off that first 15-minute low was 68.04. It started to move down, and then it closed below there 67.72. We owned the December monthly options, December 21st expiration. We bought the 70 strike puts. So stock's in the money and going more and more in the money, and then we took half of them off at a 30% gain and took the rest of them off at a 50% gain at 4.5 versus our initial entry around 3. So, very nice quick trade for us there, and now you see it's giving the exit because this last retest was ever so slightly violated right there in the last 30 minutes of trading today. So now it's back into that no man's land on the 15-minute chart. Oh, by the way, look at the breakdown under the acceleration band. That's where you can get a waterfall effect as these at the bottom potentially falls out of the stock. And so from that perspective, a pretty eye-opening type of a situation. Now, if you're an option trader, you'll notice that you can even plot the options value. We look at options charts like a TradeStation and other vehicles. So you look at the 70 strike puts, and you see how those things. We bottom a little bit. I'm sorry. I'm taking that back. We had the weekly options. I'm sorry, the 13-12-06. This first Friday in December options. That was the 70 put. Like we said, bought at 3 a couple days back, and then blasting off here. There was our 4.5 hit 460, and then settled back at 385. So we're happy to get out of that. That technically was a retest there as well at the low of 395. So and it didn't close under that, even though the bid was under that. So you're going off of the trades. You can see the option chart's not as active as the stock. So we're still putting a lot of our emphasis on the stock. Now, where do you go to take your education to the next level? Because I'm already into my hour here, and I don't want to. I have to make Fausto and his crew have to, stay unduly late. But bottom line is that we set up a special page for you here at bigtrends.com/trade-secrets. I'll copy that and put it in the chat box here. And we'll come back and talk a little bit about any final questions here. But when you go to bigtrends.com/trade-secrets, I told Fausto I wanted to give you all a special offer as a CTU community member. And what I've done actually is I'm doing a special year-end blowout until these supplies are gone, which is coming up pretty soon. The bottom line is that these are 3 different DVD education trading courses tying in option trading details, and each one's a little bit different. This first one, Automate Your Option Trading, goes into a better trading system approach, so really going a little deeper into some of the key parameters of developing a successful trading system, whether you trade stocks, futures, Forex, or options. And then I also go into a lot about managing your psychological capital. What we talked about earlier about all those key elements that imprint on your trading psyche, you've got to know how to manage them to really get the most out of your trading ability. Then in the 90-minute workshop called High Impact Options Trading, I spent a lot of time on acceleration bands in that one, in addition to some other key rules of thumb to follow. And so basically, you'll learn about acceleration bands, and you'll also get backup on tools like the %R and more specific rules I look for. And then the 7 golden rules for option trading success. Now you're going into some additional key elements that you've got to factor in to help you fix what I call the top 10 problems that all traders face. You also learn more about option charts, which nobody talks about, which blows me away. If you trade options, you need to be looking at not just the stock, but also which option you might be trading and look at the chart of that and say, is it giving me the right risk reward profile? And so each one of these would usually be between 60 and 75 bucks a piece, but what I'm doing as a special to Fausto and the CTU community here today is I'm allowing the ability to get the entire 3-DVD, what we call our Trade Secrets library, 5 hours of content for just $49 total, all in. If you're in the U.S., we'll even ship it to you free. So when you hit the Add to Cart button from the Trade Secrets page, bigtrends.com/trade secrets, then bottom line is that if you're in the U.S., you can just hit that the U.S. link. If you're overseas, it's a nominal $14.95 added, not 3 times, but just once. So, you know, it's a nominal expense, so basically to just cover our costs. We're not making anything here after we factor in all the time and energy and costs that went into making all these DVDs. But the bottom line is that it's a way to give you kind of an early holiday present, if you will. Certainly you're saving about 2/3 off of what the list prices would be on all these, and you're getting a chance to really just continue your options trading education. I find that options are still increasingly popular because a lot of people are trying to learn how to get more bang for your buck. So you just fill out your basic information there. We take the main credit cards and PayPal, and then bottom line is that we give you the terms and conditions here. Check those out. Check on the terms box, and then submit your order. You'll get them shipped out to you right away tomorrow, so we'll get them out to you promptly. You also start to get some nice extra bonus educational content from us here at Big Trends, where you can really start to more of a drip approach to gradually training on the right trading habits. So go to that page, bigtrends.com/trade secrets, check it out, and you'll, I think, be impressed with how much you're getting. You can look them up online too and see how each one would typically sell between 60 and 75 bucks a piece. So it's a couple $100 of value for just 49 bucks here today. So make sure you take advantage of that. And bottom line is that you really want to make sure that you're using the right trading principles. I want to answer a few last questions here that folks had here. Confi says, what happens to an in-the-money option if it goes against you? Do you lose the same amount of intrinsic as when it goes in your favor? Not exactly, Confi. You get a slight benefit because as you actually see it go against you, it actually loses a little bit of delta. So actually you see it going on each point against you less and less against you on the intrinsic amount. You actually, as you go closer to the strike, you actually pick up some time premium. That principle is called convexity. I talk about that in the DVD course as well, and another reason why in-the-money options make a lot of sense. So from this perspective, we'll walk you through that. Douglas, we do have a specific Forex course. Call us at our 800 Big Trends line if you want more information on that, and mention that you heard about our Forex course through the CTU special meeting. We like to give Fausto and his team credit for any particular interest that gets drummed up from you being here with us today. And I appreciate Fausto allowing me the opportunity to share lessons I've learned over now 24+ years of trading. Douglas asked also about, are those Bollinger Bands I was using? No, you can see those bands were actually acceleration bands. So you can see here, if you look at Apple, we'll finish, just a little quick look at Apple. You can see Apple, of course, you know what happened to Apple before the last few months. It was getting pounded on the downside, especially after the iPhone 5 launch late September of 2012. You see the big breakdown here with %R going oversold, staying oversold from early October through mid-November, and that was really nasty. The stock lost 100 points in that window from about the low 600s down to almost 500. And so you can see the downside momentum was there on Apple until it started to kind of change mid-year, and we got a nice run up here in front of their latest iPhone 5S phone announcement there in August and early September, and then another run here in %R. So zoom it in here, you see where it's breaking out on Apple on the daily chart, falling through and saying, okay, it broke above that high, 497.58 there, 498, so we're buying the next open, 500.79. If you're a retest follower, that slammed down there on that retest, 514.54. That's a decent little tradable bounce up about 12 points. but then you see what happened. It then gave another retest, and then the violation, it was stopping out at 521. So from that perspective, you're done with Apple for now, and you'd be waiting on it and waiting for the next what we consider to be trend following setup. So you'll learn all about this when you go to the bigtrends.com/trade secrets page. Check it out. Now, you can use this on daily and weekly charts. Sure, you can, but you can also use it on intraday charts. So all different time frames are what works. Now, and Douglas says, thanks to Carl Icahn's purchases. Hey, exactly. You know, the bottom line is that I don't know who's moving these battleships, but I know that they're big players. And then, of course, we know that Mr. Icahn has become very good at publicizing his purchases seemingly soon after he makes them to help them along. But hey, you know, it's working for him and it's working for the stock. So, you know, he's got the halo over his head right now, and so we'll see how long that lasts. But in the meantime, yes, this will get you in tune with whatever the rationale is for why the stock is moving. Who are the big players who are moving it? I can't tell you that necessarily. In this case, we know Icahn was involved. But the bottom line is that if there's enough power there, enough thrust, you'll be able to pick that up. I appreciate the kind words, Mike, on great lecture. That's what we're here for. Now, Joan says, are these Keltner channels? No, they're a little different. Keltner channels are a little bit thinner than acceleration bands. Confi asked the same question about Keltners. And Confi asked about, do we have a live trading room? We do. You can call us again at 800 Big Trends. I'm going to type that in because we're getting a lot of questions about other Big Trends offerings. You know, so you can basically just call us at our 800 Big Trends number for more info. We'll be happy to help you. My staff has gone home for the day. I tend to stay a little late to make sure we cover all this, but basically, yes, we'll definitely help you through that. That's 800 Big Trends, which is 800-244-8736. Or you can basically get us through client care at bigtrends.com for more information. Please mention CTU to make sure you get our best pricing on this. Now, Lee says, is this for beginners? We do have some information for beginners. I tend to jump over that a little bit. I tend to assume that you've had some trading experience in these kind of classes, which could be a mistake, but we do have things that can get you started from the very beginning, Lee. If this seemed like drinking through a fire hose, it's because I've got traders in here at all different levels of experience, from beginner to advanced, and I try to give something for each of you. So I figure if you take one idea home, like the %R principle, whether you're a quick trader, swing trader, or a longer-term trader, an investor, you can apply these principles on any time frame across any trading vehicle, whether you trade futures, Forex, or other stocks and ETFs, and of course the options on those. Last question here, let's see, came from, let's see, it looks like they covered most all the questions. Yeah, I mean, you know, a couple of you asked about Keltner channels. You know, Keltner channel, you can plot it, same with the Bollinger Band, and what you'd notice is that they tend to move a little bit faster than maybe I would even like. I like speed, but I don't want to basically get myself in a position where I miss, you know, a certain move, or I get whipped out of it too quickly. That's what it'll tend to happen, is you'll get those whipped out too quickly. So make sure to go to that page. And again, just as a reminder, what we set up for you here, bigtrends.com/trade secrets. Go there now, because I'm going to wrap up the trading room for now. But bottom line is that if you have any questions, let us know at 800 Big Trends. And go to bigtrends.com/trade secrets. Lock in just by hitting the add to cart button. You'll be able to pop it into your shopping cart. You can lock in all 3 DVD courses. That's 5 hours total of content for a total one-time price of just $49 until these are gone. Once they're gone, folks, they're gone. Don't ask me later, oh, I wish I had taken advantage of it, because when they're gone, they literally are not being reproduced. So we'll be done with it. But bottom line is, check it out at bigtrends.com/trade secrets. I really appreciate you being with me here today. You know, do you have information on fundamentals on the disc, Dave? I would say no. That's one thing. I don't claim to be a fundamentalist when it comes to trading. I claim to be more of a technical trader. So this is much more technical trend following, keeping it simple. And Shay says, what's the best indicator? I would say %R is the place to start. Go plot that. When you go back and look at the trades you've missed this year, You probably missed them because you had a limited belief system. You believe that an overbought stock should not be bought, therefore you missed out on some of the biggest and best movers in the market. And so bottom line is that this will change what you see in the markets. It'll allow you to participate, but still define your risk in a sensible way so you're not buying crazy overbought situations that are going to get slammed down so much as you're waiting for that next reentry point after a retest that I showed you. You'll learn more about percent R, acceleration management, a lot more on these 3 DVD courses. If you have any questions, let us know at 800 Big Trends. Thanks to Fausto and his team at CTU, and thank you for spending your hour and change with me here tonight. If you have any questions, we're here to help you as well. So let us know. Drop us an email through clientcare@bigtrends.com or give us a phone call at 800 Big Trends. That's toll free, 800 Big Trends. Take care, everybody. It's listed up there on the page too at bigtrends.com/trade secrets. See you soon. Have a great evening and a great trading day, week, and years ahead. I know that these courses can certainly be very valuable in helping re-educate you and better educate you for a lifetime of more effective trading. Take care. Good night. See you soon.